In the first half of 2022, the stock markets have lost nearly 20% of their value, leaving a lot of retirees wondering how this will affect and impact their retirement withdrawals. So in today's video, we are going to talk about what you can do to recoup some of those losses.
Amber, this is a question we're having, right? The markets are down 20%. Should they be adjusting their withdrawal? So I want to use an example here on the screen of Kay. Kay is 70 years old, and a couple years ago, her account value was worth $500,000. So following the 4% rule, she was taking out about $20,000 a year. Well, as you mentioned, now stock market has dropped 20%. That $500,000 is down to $400,000. So Kay's concerned. Does she need to now adjust her withdrawal rates? We call these guardrails, right? If we're having really good years in the market, you can maybe take out more. Bad years in the market, you can maybe take out less. Kay's concerned that if she drops down to $16,000, that she won't have enough when combined with her small pension and her Social Security check to live. But she's also concerned if she keeps taking out $20,000 a year based on a higher amount, that she's going to run out of money in retirement.
So these are very valid concerns, and actually concerns that we see every day. So if Kate was your client, what would you advise her?
Well, one option Kay has is to actually now lock in that $400,000 value in case markets drop anymore, right? We can't control where the markets are going, so at least she could lock in that $400,000. But if her goal is income, Amber, you said, what would I advise? If her goal is income, that's one solution, right? If it's growth, that's different. But in her case, she needs income. She does not want to drop from $20,000 down to $16,000. So what could she do? She could take $400,000 and transfer that to a bonus annuity. That's just an income annuity that has a bonus. In this case, it would be 7%. So on day one, she'd recoup $28,000. But this is what's more important. 30 days later, she could turn on an income stream that would pay her $22,256,000 per year for the rest of her life. Guaranteed. Doesn't matter what happens to interest rates, doesn't matter what happens to stock markets, that is guaranteed. Now remember, she was getting 20, she was concerned she would have to drop down to 16,000. So this might be a great fit for solving that income need.
So she can actually take more income than she was taking just following the 4% rule.
Right, and Amber, the 4% rule is not guaranteed, right? That's an estimate. That's just a rule of thumb. This is actually guaranteed for her lifetime.
So the insurance company can guarantee her more income because of the law of large numbers, and we've actually done another video on this, so watch that if you have questions about that. But they can actually afford to pay her a little bit more because their risk is lower over a large number of people.
Exactly.
But let's talk for a minute about death benefit. What if Kay only lives 5 more years before she can actually recoup all of those $400,000 that she invested in that annuity?
Amber, this account would have a death benefit for approximately 22 years. So if Kay lived to age 75 or 80, then her beneficiaries would receive what's left, approximately half of the account value. But if she lives out there to age 95 and passes away, there probably is not a death benefit at that point, right? These run about 20 to 22 years. They have a death benefit after that point. Then that's where that law of large numbers come. The company still has to pay her a check even though her account balance has reached zero, okay? So they're having to use other people's money to make those payments.
So if she actually decided she only needed $20,000 to come out every year, she could go ahead and invest a little bit less in that annuity and not need to put all $400,000 into it.
Exactly. Yeah, about 10% less. She needs 10% less. She put in 10% less. So that other $40,000, for example, could be used for emergency funds or stay in a growth fund, right? Still try to recoup as the markets return, hopefully in the future, some gains. But one thing I'll point out about this, Amber, is there's no annual fees in this particular income annuity. What that means is you're not paying a management fee, you're not paying transaction fees, trading fees. There's no fees, right? Once it goes in, once the income payment is calculated, that's it, you're done.
That's great news for people who are trying to recover from some stock market losses and lock in an income.
Yeah, for retirees worried about income, this is probably a great solution. Now again, had Kay been following our bucket plan, she would have already done this years before and not been so concerned about the market losses. But because she didn't, it's not too late to correct course and have that income guaranteed for life in retirement.
But if you're not following a bucket plan and you need a little help from us, you can go to workwithnewgen.com and schedule a 15-minute introductory phone call.
Because you can make the rest of your life the best of your life.
Plan now to retire happy.